Hi, this is Claus Vogt for Money and Markets TV. We know that the government's manipulation of financial markets has led to disasters in recent years. The stock market bubble and bust in 2000, the housing bubble and bust in 2007, and the greatest banking crisis of our lifetime in 2008. But now, the government's creating even greater dangers and also opportunities for investors. It's sticking with the very same policies, and it's creating an even bigger bubble, this time in the one asset class that has been considered safe, U.S. government debt. We know how disastrous the sovereign debt crisis has been in Europe. We know that the United States finances are not in any better shape, and we can also anticipate that a busting U.S. debt could make the housing and banking crisis of 2008 look mild by comparison. The only remaining question is not if, but how a debt crisis will hit the United States as well. I see two possible scenarios here. One, the bond market collapses. This could literally happen overnight. You could go to bed thinking that the majority of market participants retain confidence in government debt more than enough to prop up the bond markets forever. But any number of events could shatter the global confidence in the United States. If that happens, borrowing would become next to impossible or prohibitively expensive. Banks would fail. The financial system as we know it would unravel, and the economy would plunge into another recession. It seems like a replay of 2008, but this time it would be much worse because governments would not have the will or the means to fight it. The second scenario begins where the first one ends and essentially runs in reverse. We start with a double-dip recession, which would cut tax revenues and bloat the federal government even further. And that would lead to a funding crisis, much as it has for many cities and states around the United States. So, which scenario will it be? It's still too soon to tell, but we already have some evidence that both are in progress. On Monday, Standard & Poor's cut its outlook on the United States government's credit rating to negative, a warning that the debt crisis scenario is very possible. But we also see new signs of a double-dip recession scenario. For one, inflationary pressures are clearly on the rise. Historically, rapid price increases have usually triggered a recession or, at minimum, a severe bear market or a crash. In particular, big jumps in crude prices have been associated with recessions in the past. With an increase of 150% in 2 years, this indicator is officially in recession warning mode here. The US housing market has also started to fall again. And as mortgage rates reset over the next 12 to 15 months, we are likely to see much more downward pressure. This doesn't bode well for the banking sector or the overall economy either. It's very unlikely for a sustainable economic recovery to coincide with an ongoing slump in housing prices. Finally, we have rising interest rates in both the United States and in Europe. The bond market is driving longer-term rates up. And in emerging markets, central banks have been moving towards more restrictive monetary policies, hiking interest rates and reserve requirements for banks. Needless to say, rising interest rates can trigger bear markets and recessions. Combine all these factors, and I believe another economic downturn is in the not-too-distant future. Governments are already massively over-indebted. Inflation expectations are on the rise, and central banks are starting to jack up interest rates. Soon the stock market will feel the pressure, and the economy will follow. And I doubt the governments of Europe or the US can pull another rabbit out of the hat. So if you're overloaded with stocks, use inverse ETFs such as the ProShares Ultra Short Financials, ticker symbol SKF. They are easy to buy, you can never lose more than you invest, and they are a very good hedge. I'm Claus Vogt for Money and Markets TV. Thanks for watching.